recording. Hi, Pete.
Hello, Don. Welcome to our charitable planning session. This is kind of what we do in part of our mission with financial and estate literacy, which is a 501c3 not-for-profit. And Don, besides being our presenter today, and I'm going to co-present with him, he's also a member of our board of directors, and I'm the founder of financial and estate literacy, and we'll get into that in just a little bit. What's so exciting about this particular program is that most professionals are not familiar with any of these techniques, and they're never brought up as an alternative in the financial world, mostly because they don't have any commissions or fees attached. And it's kind of an oxymoron when you're saying, I'm going to give money away and somehow I'm going to make a gain and it's going to accomplish some other things for me. And I'm really giving, I might not have to lose control over the money. It's just not as easy.
It's not intuitively obvious.
Yeah. So that's why it's kind of exciting. If you watch this, and hopefully you'll talk about it at a cocktail party because more people need to know about it. So the nice thing also about Don is that he's done this himself. So he's speaking from personal experience, family experience, and also as a professional. How do we want to get started, Don?
We're going to share this, and I'm going to get rid of something here. And then I'm going to go click, 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 click. And now we have a presentation. So what we thought we'd do is just sort of an introduction. Here's Pete. Here's his email, my introduction. Pete had asked me to be on the board, but also be the philanthropic advisor for finance and estate literacy. So that gives you an idea of who we are and what we're doing. We're doing this in June of 2020. Things are changing, and you'll see some of those in terms of what we look at as we go through. One of the things we do is we require an ask first form. So we're going to ask Pete. Pete, what's your master's in?
I don't have a master's degree. Well, actually, I'm pretty close to a master's.
You have a master's or other advanced degree?
I have a Juris Doctorate.
Okay,
so I'm a law school graduate, and I'm pretty close to having a master's degree in communicative disorders, but that's a whole nother story. But my credentials is that I've worked basically 40 years in this area. Worked for a number of not-for-profits, Long Beach State University, the Red Cross, American Heart Association, Father Flanagan's Boys Home, and it's always been in this area of estate planning and financial matters. So as a professional, my real life, I'm a professional fiduciary. There's my license number with the state of California. You can look me up, and which you should always do for any professional that you engage. Business relationship, I always serve as a fiduciary, always put the client's interests first.
And while you're JD, you do not practice law?
I do not practice law. And
do you perform law or just not practice? Never mind. Go on. We do have fun when we do these, Pete.
I have no idea what you just asked.
You're a fiduciary. You work as a fiduciary, and you only treat your responsibilities to the other person. Yes.
I can't put my own interest first.
Right.
Compensation. It's 1% of the assets in trust if I become a successor trustee. And we do some hourly at $250 an hour. If you want a fee schedule, please email me or ask me, and I'll be happy to send you one.
But if someone wanted to come find out if they really want you around, will you charge them a fee for just talking to them?
Never.
Excellent.
In fact, we only begin charging. You can even name us in your documents and you would never be charged. The only time you're charged if we actually start performing, or what they call being in the office of a successor trustee.
Very good.
I don't sell or associate with anyone who sells annuities, insurance, or mutual funds. And I certify that the above is true and correct.
Very good. Okay. So now it's all about me for a little bit. Why me? Why now? As Pete said, there's interesting things in terms of what I do. I happen to be a CPA, as you'll see in a minute. I'm fascinated by numbers and have been a CPA for 30 plus years or something. Over the years, my wife and I have established a living trust, advanced healthcare directive, all of those different ideas and aspects, because that is so critical. I had run a market research company for, I don't know, 25 years or something. And as I thought about retiring, our daughters asked if they could take over the company. We talked about it and said, do you sell it? Do you give it? And we finally decided we would gift the company to them. I raised that because that's another trust that we set up and is another tax return that had to be done at the time. I'll talk about that later. We also had an office building, and in a chat with Pete, when we said we were going to sell it, Pete said, hey, why don't you do a charitable remainder trust? So we looked into it, given my obsession with numbers, and studied that for a good period of time and realized that that was an excellent idea. And as Pete alluded to a moment ago, the nice part of doing something like that is my wife and I get income for life. When we die, the remainder, charitable remainder trust, goes to charity. So that's the way that is set up. We'll talk more about that when we get into those. We chose to set up a donor advised fund as a part of that trust because we wanted half of the money to go to our children as managers of the half that's remaining. So pass on the fiduciary responsibility to the next generation and perhaps to the generation after that, since they have kids. As I say, I got quite interested in what all was going on with this. Why now? When I did this slide some months ago, it wasn't nearly as interesting as it is today. It's even more interesting as we are today. So my Ask First form, I have a master's degree. I have a bachelor's degree in accounting statistics, which proves that I really am a nerd because I'm into numbers. I have a master's in international business, having lived overseas for a few years. CPA, went to work for a large CPA firm, got my CPA some 30 odd years ago. You can also look me up if you want. There's my license number as a CPA. It will be amazingly boring because I don't do taxes and I don't sign financial statements. I work with numbers. That's what I do. As I said, I'm philanthropic advisor to the finance and estate literacy. There's a software package that a lot of people use in this industry to do the what if numbers in terms of what's there. It's called Crescendo. They have a gift college, and I went through their certification program to become a certified gift planning associate on how to run the software and do various things. Yes, Pete?
How many,
I'll breathe now.
thank you. I didn't even have to say anything. We have done this way too many times. How many hours did you have to put in on that to get that certification?
They actually don't measure it that way. It has to be 50 modules. You
Okay.
do each one, you take a quiz on it, and at the end of it, you have to have a proctored exam. Someone sits there and stares at you while you take the exam, and you have to go through and do all of that. They suggest
So it's not just to give me a certificate.
They recommend you do that 50 modules over a year. Proving how bored I was, I did it in 3.5 weeks. Very intense, a lot of work, a lot of studying, and that's very good. I figured that way I'd remember everything I studied.
That's a good thing to do.
I don't practice law. And to me, the relationship is with the individual I'm talking to. And in a way, it's a bit of an anomaly of me doing the charitable giving module because I'm charity agnostic. I don't care who you give to. I care who you care about giving to. And that really is the fiduciary side of this, is I want to make sure that what you want is what you want to do. I'll push you to make sure it's a valid charity, that's fine. But it's all about whoever I'm talking to in terms of the work.
Yeah, so the difference between us, financial and estate literacy, Don, myself, is that we don't work for the American Heart. We don't work for the Red Cross. We don't work for Long Beach State University. So if you ask us a question, our only interest is you and the charities that you want to donate to. And it takes some talking through. So you want to make sure that whomever you talk to, by the way, if you talk to someone who works for a particular charity, that does not mean they're going to give you bad information.
Oh, no,
in fact,
they're very
it's
good,
a great
very
place
good people
to start.
Correct.
Yeah, because they also have the Crescendo software
Yes.
or some kind of a software, but they are employed by that organization and they want you to make the gift to them. Whereas with us, we just want you to make the gift. I think giving is just a major part of life.
Well, and to that point, two things. One, anyone who works for these nonprofits, they don't get a commission for having you sign up to do something. That's against the law, basically. They will not do that. So they have an interest in promoting their nonprofit, but on the other hand, they aren't financially hurt if you don't do the deal today. The other thing that Pete just mentioned, and I want to come back to it, I've had people that I've talked to have said, I want to give money to charity. Here's the situation. And I've told them not to do it because the owner of the property is 96 years old and in bad health. You may want to wait until mom dies, then decide what to do because of upvaluing of assets and other things. So to me, it was, they have every intent of giving money to charity, but it might be easier later than today. So that, again, is a bit of a difference in us. Yeah. How am I compensated? In theory,
lots of different scenarios, and
yes.
It's hard to find someone in this area who is neutral, who has knowledge. And so that's one of the purposes of the video today, or the Zoom meeting today, is to bring you some facts, some things to consider, and hopefully follow through.
Absolutely. In theory, I would bill a client $200 an hour. I haven't billed anybody anything because—
You haven't?
I don't, because I find it interesting. I can bill you if you want, but
what kind of an American are you?
Comfortable. I do not recommend investments. Heaven forbid I don't do that. I don't sell insurance. I don't sell any of those kinds of things. Yeah. And yes, I've signed this on punishment of whatever it is, liability.
Perjury.
Thank you. I'm not a lawyer. You are. You're the lawyer. Anyway, so that's who I am and what we're doing. Why are we here? What are we going to talk about? Well, there are things like you've lived in your house for a long time. You want to sell it and get cash out, but you don't want to pay any taxes or capital gains or any of that, but because you've been here forever. So there's a way of dealing with that to push the capital gains into a different time. It isn't that you never pay it, depending on what you do, but it may be delayed until later on.
So before you go on to the second thing, this is why it's really important to have a net worth statement where you have your asset listed, you have how you hold title to that asset, what is the cost basis for that asset, and what is your present market value. You need to know that about your own asset base, so that if you're about to sell a low basis asset, i.e. your house that you purchased 30 years ago, and so that has a very low basis, and now you sell it as a high capital gain, a charitable plan gift may work out for you. At least the way we put it, you want to run the numbers to see what they look like.
And somewhat to that point, Pete's talking about the financial side of this thing. This module that we're doing today is part of the It's Your Estate series. There's another series called It's Your Money. And in that one, we go through a lot of information on how to do exactly what Pete's talking about. This is sort of the next phase, if you will, or another piece of it. But it's very important to be able to know that.
Yeah. So like Don, you sold your business. It had a low or you were looking at selling your business. It had a low basis, larger market value. And so you're always seeing where is that capital gain? How much in taxes do I have to pay? Right. And we're going to get through some of the scenarios where we're actually kind of see what those numbers look like.
Exactly. The other thing you run into as you age, and you may have IRA accounts or something like those accounts, is what are your creative kids, as I've come to learn a lot of people refer to their kids as, what are they going to do when they inherit the money? And do they recognize what's going to go on? And yet you want to be fair to all of your kids. And so how do you look at the various pieces of that? The other one is you may have an interest in giving to a charity. Maybe because you want an income tax deduction now, which sounds on one side silly, but on the other hand is extremely important. and not just for your state to get rid of the money that way or to deal with the money. A sure income for the rest of your life, and maybe even for your kids or other beneficiaries. And you want to give to charity when you die, which is not a bad thing whatsoever. You may want to give it before because you may get a tax advantage for that. Where all that rolls us into.
Yeah, the fun thing about in the many times that I've talked to people who are considering a planned gift, a gift that transfers the money at some future point in time, is why, you know, what is the meaning to them?
Right.
From somebody who had a stroke to giving to the Heart Association, somebody who has who was homeless at one time and couldn't afford a house and committed to Habitat for Humanity. Somebody who at the Boys and Girls Club that it kind of helped them through their early years, or a university that gave them the big start in life. It's kind of saying it's a gratitude, and it's real.
Right. So why do we give? Pete just mentioned a lot of the areas. The other is that giving can result in a tax savings, and there's nothing wrong with the fact that you aren't going to get an advantage out of this. It's even better perhaps if you can. We're in the United States, our tax system is unique in the world, and that is that the U.S. government encourages us to make charitable gifts, social welfare. It allows each individual to pick whatever cause, whatever mission that you have a desire to support, to pay them, so to speak, directly, versus going to Washington, D.C. first and then for the social welfare. So the U.S. government encourages charitable gifts because it's better economically, and it puts more dollars to better use versus a bureaucracy. And the other side of that is there was just a report released recently that $450 billion was given last year to charity. It wasn't all by individuals, although the vast majority of it was given by individuals. And that's, to Pete's point, is supporting locally, supporting national, whatever it is, but that's beyond what the government may be doing. I just visited, 3 months ago, Salvation Army. They have an entire program for alcoholics that they have 6-month in-house program at absolutely no charge. Can you imagine if the government was involved in setting up that kind of a program, how much in taxpayer dollars it would cost? And so it just goes on. In Orange County, the number of homeless people is just dramatic. And United Way is just stepping in there and using its fundraising powers to help the cause. Right. So it just goes on. So from a income tax standpoint, if you itemize your deductions, you can get a deduction against what's called your adjusted gross income. And that's on your tax return. If you gave cash, you can take 60% of it against that adjusted gross income, or up to 60%, and 30% of it's appreciated assets. It also reduces your estate tax if you have a very high estate, and we'll talk about those in a couple of minutes. It can also generate income for you, for your beneficiaries, or for both of you, and it makes you feel good. You're supporting your favorite charity or cause. Supporting others is just doing a good thing, as Pete said, all the issues we have today. And frankly, you're going to live longer. And it's one of those things people go, yeah, right. Okay, I'm nice. However, it's research that's been proven. It has been proven. And in fact, it's been an interesting exception in the charitable giving side, because they plan on what's your life expectancy. If you give, it tends to be longer. So they actually have to think about that when they guarantee something to you for life. You're probably going to live longer. So yeah. I was met with a financial advisor yesterday, and he was concerned with the whole virus thing. And he says for his clients, they're looking at commercial annuities.
And he was looking at a commercial annuity. And I said, have you ever looked at a charitable gift annuity? It could give you very similar rates. It's guaranteed, et cetera, et cetera. He says, you know, when I hear the word charity, I don't think about income.
Right.
And so he's going to run some numbers, and because a charitable gift annuity could generate income,
which we're going to talk about in just a couple minutes. Given the time frame that we're in, given that we're recording this in June of 2020, there's interesting things going on. We have unprecedented economic impact. There have been some laws that are changing not only your day-to-day life, but what happens to you in the future, in a sense. The CARES Act had the $1,200 per person. We don't need to talk about that. Unemployment benefits were increased, payroll protection plan. But then you get to what was the Secure Act, which was actually last year, but is affected by the CARES Act. So last year when the Secure Act went through, they said, and we'll talk about required minimum distributions. It used to be you took them at 70 and a half, now it's 72. But during 2020, if you are required to do a minimum distribution, you don't have to take it in 2020. Now, the exception to that is if this was a carryover from 2019, you still had to pay that one. But if this is your money for 2020, you do not have to take it out. You can also do a qualified charitable distribution instead of your RMD. We'll talk a little bit more about that, but that also has changed this year with different levels. One of the key things in terms of planning that a lot of people run into is what was called the stretch IRA. When I pass away, I could give my children my IRA, and it used to be they could take that money out over their lifetime. They could leave it in and let it grow tax-free, all the good things if that's what they want to do. Now the maximum is 10 years. And that's a real difference, real big change to a lot of people in planning. So the contributions against your AGI, normally you can take 60%.
Before you go there,
please.
Don, I just want to, the stretch IRA change means that a charitable remainder trust may be a tool that you want to look at, because
which is why
that
we're going
can
to talk about
last.
it.
Yeah, that can last for a long time. So
the rest of their lives, yes.
Plant that in folks' heads.
Perfect, perfect. Charitable deductions, normally, as I said, cash, you could take 60% against your adjusted gross income. For 2020, they allow you to take 100%. So if you had adjusted gross income of $1,000 and you want to give $1,000 to charity, you will have no income tax because you'll zero out your adjusted gross income for this year. Normally, it's only 60%. Also, they changed it that if you take standard deductions, we'll talk about in a moment, you now can still give $300 as an above the line, as they call it, deduction, where normally that would not have been allowed because it would have been in your standard deductions. Appreciated assets remain at the 30%. But note that this is as of June 2020, things could change tomorrow.
Yeah, and so before the end of the year, you can't do it at the next year. Before the end of the year, talk to your CPA, especially if you want to look at making a significant gift, or you want to, you have to take out a significant amount from your IRA. Things are complex, and you need the professional, but you need to see the professional before the end of 2020.
Right. Yeah, this isn't after year end. So federal tax returns or tax rates at this moment are 0 to 37%. California is 0 to 13.3. Medicare supplement is 3.5. We're doing this with California because that's where we happen to be. So if you're paying all up income tax, you're over 50%. That really bothered me the other day when I was doing this, and then I realized when Reagan was president, the maximum federal rate was over 70%, 70. It's dropped. Now, not a lot of people paid the 70, but it was in fact much higher in the past. They changed a couple of years ago the personal exemption. So now you have a $12,400 as an individual, $24,800 if you're married, as a standard deduction. You don't have to explain anything or anything else, which is why a lot of people no longer get a charitable deduction because they're taking the standard. There's also a $1,300 bump about age and low income and other things. I won't go to the details of it. Interestingly, when you look at some of these things, capital gains is much lower than the federal rate. So 20% for federal, 13.3 for California. So it maxes at only 33% rather than over 50. The gift tax allowance, you're allowed to give anybody $15,000. You can give it to them. They don't have to report it. You don't have to report it, as long as it's up to 15,000. So,
by the way, you can give much more than 15,000.
So my wife and I have 2 daughters. They're both married. They each have 2 granddaughters. So we have 4 granddaughters. So if I gave each one of them $15,000, I've now given away $120,000 of my estate. If I had a large estate, that's very important. But Jean could do the same thing. So the 2 of us every year, in theory, could give away $240,000 without reporting it anywhere. So,
right. And the key is without needing to report.
Yes.
You can give more than $15,000 per year.
Absolutely.
And not pay any tax whatsoever.
Right.
It's just that you have to report that amount.
So inheritance tax exemption, the next one down, is currently 11.5 plus million. Married, it's 23. That's a huge amount of money. And last year, only less than 2,000 tax returns required any form of taxation on it. Anything over that, you pay 40%. Now, over that amount, so if you had a $30 million estate, you'd pay 40% on 7 million, not on 30. So that is important to know the difference on that one. So it's a lot of money, and rarely does it really come into play, but it really is something to think about. Now, in my particular case, when we gave the children, when we gifted the company to them, I had to submit a gift tax return. No tax, as Pete just said. But in my individual case, I now have only 9.5 million. Don't need that. I have 9.5 instead of 11.5 because I already used 2. And so that stays on my record until I die. And then it's, okay, that's how much. So I've used part of my inheritance tax. I had to pay no tax, no anything when I did that.
So 99
plus
percent of people in the United States do not have any concerns with estate or inheritance taxes.
Right.
So don't be fooled by any kind of death taxes. They're, for almost all of us, it's a non-issue.
Correct. So now we start getting into some of the funny numbers and other things. This is sort of an alphabet soups, IRDs, RMDs, QCDs, all of those things. The important part of this is your IRA, your 401k, 403b, any of those kinds of accounts. The money went into it before tax. So the IRS wants money when it comes out. It's not a Roth IRA because they took tax on that one. But on a standard IRA, 401k, 403b, they want their taxes back when you withdraw the money. So on a required minimum distribution, again, we said the number has changed to 72. I use Jean and I as an example. Jean happens to be 6 months older than me. Jean turned 70 last year. On my birthday, 6 months later, 70 and a half. She had to take RMD last year because she was 70 and a half. I turned 70 and a half this year, 2020. I don't have to take it until I'm 72. It's interesting how they make these things challenging for some of us who have matured in age, if you will. So that changed.
It's kind of like, why did they make it 72 and a half?
Right. Yes. Yeah, that's a lovely number.
You know, I mean, it's just,
yeah.
Who knows why these laws are made? It probably was a compromise somewhere, and somebody wanted one date, the other one wanted the other date, and so they cut it in the middle.
Well, and because to the IRS, when you are 70 and a half, your legal age is 71. They move up to the highest one after the half year. So they probably look at it and say, well, you only changed from 71 to 72. Yeah, but it's 70 and a half. So what is your RMD? Because a lot of people are confused by this. So it's based on whatever the value is of your account as of year end last year. You take that and you would put it towards a factor. So as an example, this was updated numbers as of this year. So I'm going to use as my example, an 80-year-old has a factor of 20.2. So if she had an account $500,000, because I like simple numbers, 80 years old, she would divide 500 by 20.2, and the answer is her RMD will be 24,753. Next year, she'll look at the end of her account at the end of the year, and her number will go down next year, because I put in the 5-year increments. They're actually changed every year, and there's a table you can get from the IRS, and that will mean they're going to have to take out more money. Incidentally, the rate changed. They went up, so you take out less money. So it used to be a year ago, she would have had to have taken out 26,000. Now it's only 24,000. The money that comes out is taxable income. Pure, simple, taxable income. So in talking to people, they go, well, wait a minute, that puts me in a higher tax bracket. It makes my Medicare charge go up. Yes, and that's something you need to think about when you take out that required minimum distribution. An alternative to it is, for an IRA, not a 401k, once you've passed 70 and a half, you can have money paid directly to a charity, and it does not count in your income. You'll get a 1099-R, I think it is, and you're going to request from your provider, pay this money to American Heart Association, X amount of money. And you're going to have that come to you, payable to the Heart Association. You're going to take a photocopy of it, save that, and then when you do your taxes, you're going to say, this was my RMD, but I gave this much to charity. You don't have to give it all. You can give part of it. Give as much as you want out of that. Now, there is a limitation of $100,000. So if my little example over here of this 80-year-old, if she had in excess of $2 million, she could only take 100,000 of it. Sorry. And somebody challenged me the other day, why that number? Why not? It's probably a negotiation from somebody. So you requested, and that's what you do. So that way the money never really comes to you, so you don't have to pay tax, lower bracket, and you don't have to increase your Medicare. So, and whether you can give whatever you want. If you give money to your church, if you give money to anyone local charity, if you do it through a QCD, you don't pay tax on it. Let's use an example. So in this particular case, if my 80-year-old friend gave $15,000 to charity instead of taking all of it, then what she would have wound up with is 24,000 she received rather, but 15 of it went to charity. So she'll only pay tax on 9,753. Let's assume for simple numbers, her tax rate is 20%. On $15,000, she just saved $3,000. So if you're giving any money away, you can save money, the tax money, by doing this. Because if I wanted to write a check to somebody for $15,000, I'd have to have taken out 18. That's the savings that you have. And that's why QCD is really important. Now, this year, there is no required minimum distribution. So you don't need to worry about it this year, but you can still give to charity if you want this way.
And Donna's the number cruncher. I have a CPA.
You do?
Who crunches the numbers.
Oh, yes. I was going to say, no, you don't.
So the bottom line in this is that if you're going to give some money away to charity this year and you're 70 and a half, look at doing it from your IRA account.
Yes, absolutely true.
It'll save you money.
Yep. Okay, the other way that we talk a lot about through all of this is a bequest. A bequest is giving money after death. So through your trust, your will, whatever it happens to be, you say, I want to give money to charity. The other person I pick on or use as an example is my sister. She's widowed. She and her husband had no children. She wants, on her passing, because I'll be her executor, she wants to give money to charity. Okay, no problem. And as Pete said a minute ago, why do you want to give it? Because I don't want to just hand this check to somebody. I want to make sure they understand why they're getting it and what you wish to do. And that's very important when you're doing a bequest. It could be an outright gift or it could be deferred. She could put in the money as on death and have it go to some beneficiary after her death. She will not, it's paid out of the estate before they look at estate tax. So if you had a tax issue for your estate, you can do a bequest and it reduces down that amount. We highly recommend that you give a percentage to charity. My sister is an example. She originally had X amount of money to this charity, X amount to this one. And I said, that's fine, Nancy, but if your estate goes up or it goes down, now it changes the ratio. Why don't you say X percent, 5%, 10%, whatever it is, and the rest of the money will go somewhere else. That way it automatically moves away with it. An important part of a bequest is you get no income tax deduction while you're alive. Your estate will get a deduction if it needs it after your death. So I pushed her on, you may want to give something now because it'll reduce your income tax, which she would really like to do.
Yeah.
So.
But you know, bequests are, it's a little bit hard only because we talk about death. The good news is it doesn't cost you anything today. I've never had an individual, a beneficiary, get upset about a 10, 15, even 25% going to charity, because usually the after-tax dollars, especially if it's from an IRA, it's different. It also tells your children or whomever what's important to you. You know, what do you value, and how do you pass values on to your children through a will or a trust that's basically written in legalese as to what is important to you. And I would have loved to have known, you know, from my father as to, we're Dutch, so being Dutch, we're a little cheap. And
I'm Scottish, don't tell me about cheap.
So what did he value as far as a mission or in his life that he would have been willing to give some of his hard-earned money to? And it would have been interesting to know.
The other thing with the bequest is they're also revocable. So you can change that. You haven't given anything to them. You've said, this is what I would like to do, but you can change that anytime during your life.
Or you could even put it in such a way as, because people don't like going to an attorney and paying those fees, you can indicate, hey, I want to give it to my child, but if my child is not living at the time, I want to make a contingent bequest. Yes. I want it to go to X charity, right. You know, so there's lots of things. And what I find is that there's a lot of attorneys out there that will not encourage you to make a bequest to charity, that they have their own personal philosophy that everything ought to go to family or some individual and not to charity. So you need to bring that up, and we'll show you a way also where you can make a charitable gift to a donor advised fund, which we'll talk about later, and have your children decide as to where that money goes.
Right.
What a gift you can make to your kids, and how they can be so important in the community. But we'll talk about that a little bit later.
Yep. As a part of that, you also have a beneficiary designation. So you can name a charity or specific individuals or something through a beneficiary designation. And that way the money doesn't come into the estate, it passes directly to them. Out that's going to go, and it's no problem. This is particularly important where you have a pre-tax account, an IRA account or something like that. Any of those types of documents, if you can give them out to the individual, it's going to be fully taxed to an individual, but it would not be to a charity.
Beneficiary designation forms are on insurance policies, on IRA accounts, on 401ks, 403bs, 457s, savings accounts at banks, checking account. You can literally walk into a bank and say, if when I die on this account and I still have it, I want it to go to X charity or X person. So it avoids probate. It's called a paid on death account. And there's lots of, doesn't cost you anything in legal fees. And but highly recommend to use charities on your IRA accounts if you're going to donate to a charity.
Right. And a very important part, however, to remember is beneficiary designation overrides a will or a trust. Yes. You got to make sure you pay attention to it.
Make a copy of them.
I know a couple who have been living together for a very long time. He passes away, and the issue was he never got divorced. So the wife would have gotten everything in that particular account, except he did a beneficiary designation to his long-term partner. And the long-term partner got the money, regardless of what the will or trust had said. That's where it went. But you can have it the other way where, shoot, I forgot to remove the ex-wife. And so that's another issue. Pay attention to them. And remember, if something significant changes, go look at these.
Just, and also remember that charities don't pay any income taxes.
Right.
So
Right.
100% of the monies that you give them gets used by that charity.
Yep. So we're going to talk about IRAs. And this, in a sense, has nothing to do with charity. This is just be aware of what's going to happen with your children or what's going on. The Secure Act, as we said before, reduced the long extension of the, being able to pull out your IRA over the rest of your lifetime to maximum 10 years. But it means that if you pass this to your child, they can take it all out on the first day. They can take out 10% a year, or they can wait and take 10% at the end, or take the whole amount at the end of the 10 years. But they have to take it all within 10 years. Now, there's exceptions if you give it to your spouse, if you give it to someone who's less than 8 years old. Difference in age, my wife is an identical twin. So if she gave it to her twin, she could still extend it out because they have a remarkably close birthday the same day. And there are other, medical terms, other issues, but as a general rule to your children, they're going to have to take that within 10 years. What are they going to do with it? And how are they going to handle it? Are they going to call the Maserati dealer, take the entire amount of the IRA, buy the Maserati, and then get a tax bill for the entire amount and not have the money, which happened recently to someone I know. So the issue is pre-tax accounts are fully taxable to the individual. They're not taxable, as Pete just said, to a charity. You may, however, want to consider take that IRA amount and open up a testamentary trust after you pass and have a charitable remainder trust or some other kind, fund it with the IRA, and now you can specify how much your children are going to get, and it could be for the rest of their life, not just 10 years. So that's a really important one.
Yeah, I had a wonderful meeting one time with one of the professors at Long Beach State University, and he was in the social welfare department. And I went over to his house. He had been retired for about 15 years, and his son at the time was 60 years old, and had been or was an alcoholic, and he'd been through AA, and he'd been sober for a good 5 years, and so, but they were afraid that if they left him their IRA account and a large amount of monies that at one shot, that it would entice him to possibly revert back to the alcoholism. And so we had a meeting with the son, with the parents, and we talked about it, and they decided that to do a charitable remainder trust as the beneficiary of the IRA, which meant that the son would receive income on a quarterly basis for as long as he lived, and whatever is left over in the trust would be used by Long Beach State University Social Welfare Department for the study of or research in alcoholism.
Sure, yeah. So we mentioned a little bit about this in terms of the money. Here's a hypothetical. So got an estate of $2.5 million. 1.5 million is in an IRA and $1 million for the house. Typically, you'd say, oh, give the $1.5 million to the kids, it's more. But they're going to wind up being taxed on that $1.5 million, over $500,000 to the feds, almost $200,000 to the state of California, and you'd wind up with less than 50%. You're at $745,000. The charity get the house in this case. If, however, you gave the charity a 1.5, which they'd be thrilled with getting the extra $500,000, and you gave the kids the house, they pay no tax on the house. The kids can sell the house immediately for $1 million because it up value on your death. So now the kids get $1 million, the charity gets more, and all you've done is reverse who got the money.
Yeah. And by the way, 90%, it's an amazing statistic, do exactly the opposite.
Of course.
They name the charity and the trust, and they put their kids on the IRA account.
Yep. So for the creative kid, so let's say you have this $500,000. So this is being prepared. You're going to put $500,000 into the trust. The trust over the lifetime of this child, who we assumed in the example is 45, is going to take out $1.4 million. Not 500,000, which you would have taken and done whatever with. They're going to receive far more money over the years because of putting the money in. And in this case, this remainder trust actually grows, which means they start out at $25,000, but year over year, they're probably going to get more money because it's actually growing in size, and it's a percent, in this case, 5% against the value of that trust. So now you've been able to grow and been able to control where the money goes, and it can go for the rest of their life. There's not a restriction. Now, one of the things that comes up with this is a charitable gift annuity. A charitable gift annuity is, and Pete had referred to the financial advisor who was looking at buying a potential annuity. Charitable gift annuity, the rates are basically set by the American Council on Gift Annuities. 97% of nonprofits use the rates that you see here. In the state of California, they almost certainly have to use this rate because a charitable gift annuity is regulated by the insurance commissioner, and the charity has to be licensed to be able to issue this. So they have to follow the rules because we're, surprise, surprise, a heavily regulated state. So the rate is based on your age or your spouse's if it's a dual life, because you can do it for yours or a dual life. The rate is locked in at the time it's established, and it does not adjust over the years. So this does not track with inflation, full disclosure. However, it's going to be paid out for your life, not a specified period of time. The charity, it's irrevocable at the time you sign it. It's a simple little 2-page document probably, no lawyers, no nothing. You can read it, come back in a week or a month or whenever you want and say, okay, I want to sign it now. There's no sales pressure. No, oh my God, you got to hurry up and do this. Nope, none of that. It's very simple form. Charity has to set aside assets to make sure that you are protected, and before they can pay any other creditors or anything else, anything that they have has to be going towards having this for a charity. So you want a major charity, but basically only major charities can do this because of all the regulations they have to follow. You can set this up for now, get the money. You can set this up to be testamentary for someone else. You can delay when it starts, any of those kinds of things. To us, one of the key parts of this is people go, I have this great stock, and I pick on Berkshire Hathaway. Great growth stock over the years. Let's have compounding. Okay, but they don't pay a dividend. So you're asset rich because of your Berkshire Hathaway, but you're broke because you have no income. If you gave that to a nonprofit, got a charitable gift annuity, now you're going to get income from it. These rates that you see here actually go into effect July 1 of this year. They just changed them. So these will take effect, we're doing this late in June, they'll go into effect in about a week in terms of what they're there. Let's look at an example. So if I had $500,000, I would get 5.3% is the rate that I'm going to receive the rest of my life for these two people, dual life. They're older, 75 and 80, I believe, in terms of what they have. So they're going to get that. But today, they're going to get a $200,000 tax deduction. So that's against their income tax that they can deduct this much money from their adjusted gross income, current and 5 years forward. We'll talk a little bit about that later on. But being able to go through and do that. So at their life, because 75 and 80, they would pull out almost exactly what they put in, $495,000. But remember this 5.3% annuity, it will actually earn 5.13 because a large portion of what goes into this is a gift, and a large portion of it may be appreciated assets. So you'll have part of it that comes out tax-free, part of it that comes out at capital gains rates. So it is a very different rate than just saying a commercial annuity. So this actually pays out 7.13 is the rate.
So the illustration that you see on the screen is what Crescendo software provides.
Right.
And so if you were to ask Don to say, hey, Don, I'm thinking of possibly, I'm curious as to know what a 200,000 gift annuity would work for me. He would ask you your age, whether or not you have a spouse, what income tax bracket you're in, and then run an illustration for you, something like this. And the important number for you, because it'll be different for every person because they're in different tax brackets, is that 713%. Where can you get today a guaranteed income stream of 7.13 return?
Right, for the rest of your life.
For the rest of your
Incidentally,
life.
to get into a charitable gift annuity, most charities will say you need at least $10,000. So this isn't a large thing. I mean, I use $500,000 because it makes the numbers look more interesting. You could go into this with a $10,000 fund if you want. You're not going to get a lot out. 5% times 10,000 is not a lot on an annual basis, but it is there and it's available to you. Nothing wrong with that.
Yeah.
The other option,
but just for a second, you can do a gift annuity from your IRA account.
Yes. Oh yeah. Right.
So so it needs some setting up beforehand. You can't do it automatically. But
Right.
if you want somebody to get a guaranteed rate of return for the rest of their life,
Yes.
it's a great way to do it.
The other thing that can be done, in this particular example, we have a 55-year-old. This would be a very low rate this person would get if they were trying to come straight into a gift annuity. In this case, they don't want the money now. They want to wait 10 years. In 10 years, they're going to, today, they're going to get a $160,000 tax deduction, which is going to be against the income, which probably is higher today than it will be later. They get that immediately. They're going to wind up taking out $816,000 because this little number up here in the middle, let's see if I can point to it, they're going to take out $32,000 a year. Now, that's 6.4%, which is a very high number compared to the other numbers we've just looked at, but it's because it's being delayed 10 years. So even you don't have to be 80 to do one of these things. You can be younger and just defer it out to sometime in the future.
And it's earning interest during the time it's being deferred. So it's growing.
It's growing.
Yeah. The question I always get on a deferred gift annuity is what happens when I die? Well, if you die within those 10 years, it goes to charity. So whenever you talk about these gifts, you got to understand it is a gift income instrument.
Right.
So it's not just a financial decision. It's but if you're going to make a gift, what a way to do it and get something for yourself.
Right. Right. Before we go into charitable remainder trust, do you have anything in general you want to talk about, Pete? Because now we start getting into some bigger things.
Yeah. The charitable remainder trust in general works with assets that have a market value of 300,000 plus, because it entails an attorney, it entails some money management, and for a smaller amount, I would stick with a charitable gift annuity.
Interestingly enough, I say 500,000, but that's fine.
Okay, yeah, 300,000 to 500,000.
Yeah.
It depends on the situation,
right,
and that type of thing. So, but if you think of a charitable trust as your living trust, it's almost works exactly the same way, except your beneficiary, the remainder beneficiary, the one that's going to get it at the end of the income beneficiary is going to be the charity.
right.
And so that's the way to look at this, because people get confused. And a charitable remainder trust is a lot of times shortened by CRT, charitable remainder trust. And you're going to see the use of the word CRUT and CRAT, and we'll talk about that in just a little bit.
So basically, as the example, Pete said it, it's capital gains assets or other things that have grown. In our case, when we sold the building, we had paid luckily, a very small amount when we bought it, and it had grown significantly over the years. Sold one, 1031 exchange, got another one, and wound up having a very nice profit. The problem is we would have paid tax on that, and I didn't want to do that. So in looking at a charitable remainder trust in our case, a remainder trust means you get money now, the rest of your life. The charity gets the remainder. In a charitable lead trust, interestingly, the charity gets the money now, and the beneficiaries get it later. Odd, except think of something like Facebook or Amazon stock before they went public. If they put that into a lead trust, paid a charity some money along the way, when it comes out for their heirs, it's not current value, it's the value it went in at. And now you have a very significant tax savings. Those are rare, not a common thing to have, but certainly a remainder trust is more common.
Yeah, I see the remainder trust used mostly in situations that you described.
Right.
I have purchased a warehouse. It was at it's now a low basis because of the depreciation that you had to take. Mm-hmm. I see it used in the Big Bear cabin. I've seen it used in individuals who have real estate rentals, and they go, I don't want to have any more tenants or toilets. I want to get rid of it, but I don't want to lose the income that I was receiving.
Well, that was a situation that's what the office building. And for 20 plus years, I was the tenant of our building. I didn't like me as a tenant because I didn't want to have to worry about a building. So there was no way we were going to keep the building and rent it out. And given what's happened now with stay home working, I'm very glad that we got rid of the building when we did. And so it's gone. But what you wind up with is you either get a fixed amount, a fixed percent of value, which is a CRUT, or a fixed dollar amount, which is a CRAT, because it's charitable remainder annuity trust. A charitable remainder annuity trust can run out of money. If you say I want a fixed amount over time, that could run out of money. A charitable gift annuity can't run out of money because it continues on its guarantee. In our case, with the charitable remainder uni trust, CRUT, we get a percentage of, so December 31, we value it. What's the value of the stock portfolio that it's now in? We get out X percent every year for the rest of our lives. We can't say no, the money's gonna come out. We can't have more, can't do that because it's required to be this certain amount. It could get less over years if we took out more than it grew, but it's gonna continue for the rest of our lives. Right. We specified charities when we set it up. In our case, we had 4 charities that we specified. Those 4 share half of the assets. We can change those 4 or how much the percentage is anytime we want, while either one of us or both of us are alive. So if we decide we don't like that charity or it's gone out of business or whatever it is, we can change that. What we then did was the other half, we opened up a donor advised fund, Pete just mentioned, and the half of our trust goes into that money. It can either be for a fixed period of time or the rest of your life. In our case, rest of our lives. A charitable remainder trust or a lead trust requires an attorney. It's this nice, big, fat, thick document, and it is irrevocable. Now, there are things I'll talk about in a minute in terms of there is value, and you can deal with that. But basically, you're not going to get out of it. The joke is in the state of California, the only person who could void our trust is the Attorney General of the state of California. And these things are serious documents. Yeah. So let's talk about it.
Yeah, I've had just for practical purposes, a friend here in Laguna Beach who had 3 properties, and 2 of them were the income properties, and he suffered a seizure, and so he couldn't drive any longer, and he was getting very tired of managing those 2 apartments because he was a hands-on individual and kind of fixed everything that he did. And the most that he had ever donated to charity was $100 at any one time. And it took us about a year of running the numbers, of explanations, showing that if he donated that income property to a charitable remainder trust, he was actually getting more money
Right.
on a monthly basis than he was at the rental, and the income tax deduction was just huge. He didn't even have to pay the capital gain.
Right.
And so I call him my poster child of the charitable remainder trust, because I used to get 2 to 3 postcards from him and his wife from all over the world on his travels, and they were using the income from the charitable trust to pay for those travels.
Correct. So as an
Worked out
example,
marvelously.
oh yes. So in this case, I keep using the number 500,000 for a number to have. In this case, you specify what percent you want out. Now there are rules, and the Crescendo software will say this. For instance, in our case, we wound up taking 10% a year out. We could have taken 12.5%. Crescendo told me that. He said, nope, we don't need that. So in this case, they chose 7.5. Now, if you remember at this age, the charitable gift annuity paid 5.3%. Couldn't change it. With the Uni Trust, you can change it and set it to be reasonably what you want. So in this case, putting in 500,000, they're going to get $200,000 tax deduction. They're going to take out over their lifetimes, and they're 75 and 80 years old, they're going to take out $609,000. And that 7.5% is actually earning 8.5%.
And by the way, this is not a freebie that the government is giving you.
No,
it's like it's like if you had a 5% payout on the Uni Trust, your tax savings would be much higher.
Yes.
So that's always what the analysis would be. Is what is important? What do you need? Do you need the income tax deduction? No. Or do you need the income from the trust? And it also depends on your age. Don is 70 years old, or is it 71? Don, I can't remember.
No, you're 71. I'm 70.
So the previous slide that we showed, where it was for a 45-year-old.
Right.
And we used the 5% because that made better sense.
Right.
I know it's a little bit weird, but it made better sense for that 45-year-old to take 5% out of the trust, so that trust grows and therefore delivers more income for his whole entire period of his life.
Where the bean counter that I am said, I'd rather have more money now, less later, and therefore let's take it out now because
and that's why it's so important to play around and takes analysis to get comfortable and Don, are you your own trustee of your charitable trust?
I am my own trustee of our trust. My
so
wife
you
and I
have
are
control.
the trustees. I'm sorry.
Yeah. So you have control as to who you want to do your taxes, who you want, how you want to invest your money. And most people think that a charitable trust means that the money is out of their control.
Right. So in our case, we're the trustees of the trust, but we hired a fiduciary financial advisor to advise us in terms of investments. And there is a tax return that's done with this. So our accountant does it. I'm a CPA, but I'm not doing that tax return. And there are all kinds of rules and other things. Incidentally, on Pete's comment of looking at what works best, Crescendo even knows that, because when you do a charitable remainder trust, they say, do you want option 1 or option 2? So you can put in 7.5 or maybe 5 and look at which one pays us more over our lives, which one gives us a better tax deduction now. And that's part of what the software does. They know people want to do that.
Yeah. I always recommend that you get a fee-only registered investment advisor involved.
Right. Yep.
And the reason for that is because you got to run the numbers. It's, you need to understand what your net worth is. You need to understand how much you're spending on an annual basis, because you want this to enhance your spending. And so, and you don't need anyone to sell you a financial product on commission. You need a numbers cruncher. And so that you can do some projections, and so that Don or whoever is doing the number crunching on the crescendo can plug in different numbers and say, okay, what if I die here? Or what if I die here? Or what if I extend it to a second life? Or what if I take a lower rate? It's lots of analysis, but the concept that I would like to leave you with is that if you have a low basis asset with a high market value, then take a look at some of these tools and see how it works out for you.
Yep. So numbers starts out at 500,000, take out 37,500. After 18 years, the projection is, these are the kinds of numbers that come out. So this is how much you get. This is how much you've taken, but this is how much you actually have after tax, which is why that tax rate is so important. Now, you might say, well, that's interesting, but my children will kill me if I give the money to charity. Well, first of all, you're already dead. Secondly is, one thing that you can do is take out an insurance trust.
Pleasant thought there, Don.
Pete and I have a very good friend who probably 20 years ago set up a charitable remainder trust that was taking out 8%. It went in at $1 million. It's now 20 years later, and it's worth $1 million. So he's been very good with his investments, but he took out a life insurance policy, second to die, so that when he dies, when they both die, the money that would have gone to the kids originally comes out from the insurance company. And so there's a crescendo approach for that, because a lot of people go, I can't, and you don't have to give all the money, and you don't have to put all the money in the charitable trust. You could say, I want to split it, and we'll talk about that in a little bit.
Yeah. And there's also, you can even extend it to the kids as well. So, but I always ask, how financially well off are the kids? Like Warren Buffett, when he first started talking about his estate plan, he said that he wanted to leave each one of his children $500,000 each. Now, remember, this is the guy who is the wealthiest individual in the world, or at the time, and 500,000. And the rationale that he had was is that he didn't want them to be a trust baby, or that this would prevent them from whatever they're doing. So I recommend that. I've got a number in mind. For my son, I said, I've got a fictitious $1 million in my mind, but I told him already, I said, it might not be there. My mother, on the other hand, felt it was an obligation that she needed to give the money to all of us children, even though we all told her, please spend it on yourself. Right. So everybody has a little different philosophy.
Buffett's recent comment was, I want to give my children enough so they can do whatever they want, but not nothing.
Yeah.
There you go. So here's a situation, as Pete alluded to a moment ago. So this is a charitable remainder unity trust plus a term of years. So in this case, $500,000, they're going to get a $164,000 tax deduction. 5% trust, they're going to actually earn 5.59%, because this is through their lifetime plus 10 more years. So this is extending out beyond your life. So that gives your beneficiaries some level of income as they go on. And it's growing because they're taking out only 5%. It's growing because they're assuming 6% of what we guess. So it's growing. So again, the income goes up over time. So one of the things that's an interesting one that's caught a lot of people's attention is, what if I want to sell my house and give money to charity? Okay, don't. So hypothetical, $1 million, cost basis is 100,000 just to make the numbers interesting. So your capital gains 900,000, 40% capital gains rate. It's going to cause a tax of 360,000, which means you only get 640,000 out of it. If you took that 640 and gave it to charity, you're going to get a tax deduction of approximately 224,000, which is going to save you 78,000. Congratulations. If you gave that 640 to charity at 80 years old at 6.5%, you'll get 41,000 a year, the rest of your life. Congratulations. If, however, instead of selling it and giving it to charity, you gave it to charity and they sold it, the charity would get $1 million. That's how much the property was. You'd get a tax deduction of 350, which means your tax would have saved you 122. So that's 44,000 more dollars you would have gotten. When you put in the 6.5%, you would get 65,000 for the rest of your life, which every year is 23,000 more than you would have. And the charity's happy because they get an extra 360,000. And the only thing you did was change the order. Instead of selling and giving, you gave and sold. So in our case with the office building, we had to put it in the charity before we sold it. And we got real close to accidentally not doing that. And it was like, oh, no, wait, take it off the market. We have to finish off the trust, put it in. Now we can go ahead and sell it. And that was really important because the only difference, we would have had to pay all the gain, and then there would have been less to give to charity and less to live on. So this is really important. The other part of going through some of these pieces is there's a thing called a life estate. If you plan to give your house to your church, which is not uncommon, I'm going to donate that to them. Well, if you do that and set up the life estate, you retain an interest in the property that you can live there the rest of your life. You have to pay the maintenance, the insurance, the taxes. That's what you get. But you get a tax deduction, which we're going to talk about in a moment. You could also do this to fund a gift annuity so that you, instead of having a reverse mortgage, you get a gift annuity. Be very careful in doing any of this because do you need the money to live on going forward? So let me show you an example. If you did a straight life estate, 500,000, the same number I keep using, you're going to get an income tax deduction of $334,000. That's important to know because if you have income now and you need to offset it, but you also have a life interest of 165. So 500,000 minus 340 is approximately 165,000. If something happened, you could actually get some access to that money. So it's all gone because you could say, hey, let's sell the property or do something else. So this is a straight life estate. This is the same thing, except now you have a gift annuity and you're going to have income for the rest of your life. You will get a smaller tax deduction because you're going to have something you're going to earn over the years. So it's an option for you to look at in terms of where you're going. The other thing, when you look at some of these is, what's the actual cost of doing this? And it sort of goes back to what we've been alluding to. Here's my infamous $500,000. You give $500,000 to charity, you're going to save $160,000 tax-wise, bypassing the capital gains, other things. So giving 500, really, half of it was saved. You really didn't have the whole amount.
So the answer, so the 95% of people who give to charity give cash.
Yes.
And probably that's the worst way to make a gift. I mean, from a tax-wise point of view.
Yeah.
So think of appreciated property. So if you have a mutual fund and you want to give some shares of a mutual fund that had a gain, it's a much better idea to give that to charity than just writing out a check. And I know writing out a check is much easier.
Now, we've talked about all of these things of let's put in the whole building or the house or something. Here's an option for you. So I'm living here in Laguna Beach. There's a $5 million property. I want to sell it, but I want money out. Okay, in this situation, you're going to give it to charity in part. So you're going to keep 3 million, give charity $1.9 million, or give charity 2 million, but the gain that you would have had would have been almost 700,000. Tax savings is 700,000. So you get out of it the 300,000. You've done this without having to give money away in terms of where you are, and yet you've been able to take out $300,000, and you got a tax deduction through doing it. But you also offset the gain, and that's the kind of thing that obviously Crescendo can do. Let me keep us going. We talked about the donor advised fund. It's somewhat like having a foundation, private foundation. except you don't have the restrictions and the overhead. Very inexpensive. You can open it at Schwab or other places. They're very inexpensive. You don't have to do all the management of it. You give them the money. It could be a community foundation or brokerage firms. I'll have them. You can say, this is where I would like to pay. Donor advised, not donor ruled. If I say, give this money to the American Heart Association, boom, they're going to cut a check and off it goes. If I say, give it to Billy Bob's repair shop, they're going to say no, because it's probably not a charity. So their restriction is they will validate this is an honest charity. And yes, you can in fact afford to give it to them. You can then pay it out over time. So one of the things that's recommended is, because we no longer have, it's less likely people will have a charitable deduction in their itemized return. If you want to give 2 years worth of giving this year, but you don't want to give it to the charity, you give it to a donor advised fund. Talked to a lady the other day. Actually, our daughters also. At the end of last year, our daughters had money they wanted to pay out of the company. They didn't know who to give it to. So they put it into the donor advised fund we have. And then this year, they've taken it out to give to very needy charities currently, and basically use that money to be able to do it. But as of last December, there wasn't a crisis going on, or not as much of one. So they're very important. You currently cannot go and have a QCD go into a donor advised fund. They may change the rules, but at the present time, you can't go through and do that. As Pete alluded to, it's a great way. We looked at it as we're passing on to the future generation, to our kids, and depending on what they want to do to our grandkids, to be able to manage that money and give it to charity. They can't take it out as cash, not at all. But they can, in fact, manage that over time.
Peter Uberoff with the Orange County Community Foundation has set up for, money is a lot of money for children is really a problem. You know, how do you understand the value of money when you've had everything given to you? One of the ways that Peter Uberoff's family has dealt with this is that they've given each one of their children a donor advised fund with the obligation that they have to give a certain percentage away per year to a charitable organization. Mm-hmm. And in order to give the money away, they have to go to the charity. They have to, yes. They find out what the mission is, and there is probably at least 100 charities asking them for money. So they have to figure out which charity out of everybody who's asking deserves their money. So it's a great way to teach kids about money.
I think when we opened our fund, we had to open it with $2,500. So they are not expensive to do. A private foundation has a lot of overhead, a lot of reporting. They're required to give out 5% a year, whatever it is. Donor advised, you can put money in and not take it out this year. And that's how you can continue it on in the longer periods of time. Someone had mentioned the other day that the largest donor advised fund they heard of was $1.4 billion, which I don't understand, but it was Conrad Hilton of Hilton Hotels. He set up a donor advised $1.4 billion. Yeah. I think I do that as a foundation, actually. But
I highly recommend that you contact your Orange County Community Foundation.
Absolutely, they'll do them.
And explore that option with them, because they know the needs in the community, whereas Fidelity or Vanguard or Schwab has no clue as to what is needed in the community. And they also have a handle on the charities in the community as well, which again, the commercial donor advised funds don't.
Correct. So bringing it all together, the whole thing, and we've alluded to have a plan. What are you doing financially? What's happening? If you use it, charitable giving to have a legacy, to be able to go into the future, that's a lovely thing. There's a lot of options. Charitable gift annuity is very simple. Charitable remainder trust is more complicated, but each has their advantages or disadvantages. So the real key is financially, what do you need now and what do you think you're going to need in the future? What do you want to happen with your estate after your death, to beneficiaries, to charities, to whoever? No rights or wrongs. Discuss it with your beneficiaries. There's an argument, we always say it's your money and it's your estate, because as I kidded before, my children will kill me if I give this away. Well, you're gone. But on the other hand, we suggest you talk. I mean, we talked to our kids and said, you're not going to get the building. And they said, good, give it to charity. Let's do these things, which was lovely. So we talked through that in terms of what we're doing. Look at the options, talk to the charity and tell them what you're doing. Why are they giving the money? My sister, there are very specific things that she wanted done by these two charities with the money they're going to get. I wouldn't have known that if I hadn't said, what do you want them to do? And so it was very important that we go through and do that.
You want to make the gift meaningful to
Yes.
you.
Yeah.
So, you know, and it, remember, and it is a gift. I having worked in charitable organizations, and so from my point of view, it's the mission of the organization that's the most important, that it matches mine.
Right.
And two is I give it for their general purposes. So, but for some individuals, I mean, at Long Beach State University, they wanted it for a specific department and to have a specific criteria for a scholarship, because that mattered to them. That made
Right.
that gift more meaningful. And it is a gift, and you need it to be meaningful to you.
Right. So with all of that said, here's a form. If you want us to run numbers for you, be happy to do it for you. You know, this is the kind of information that I would ask you about it. There's an email address at the bottom of it that would come to me. No charge, no anything else. This is just for your interest and information. Happy to do it. As I say, we've done this with a lot of people, certainly of late. And really what the bottom issue is, what are you trying to solve? Because it may be you shouldn't give to charity today. Think about it for the future or something else. So that's what we're going through. So Pete, I'm going to get us out of here. And
Thank you, Don. Good
hang on, we're not
presentation.
done. We're not done. We're back here. So we've gone through to do this because we want to just be able to have this as a tool and of interest to people, to see how people work and see how people are able to go through and do these. Let me move this guy down here and click on that. So Pete and I are next to each other on my computer. So that's what we've done. Pete, I enjoyed it, had a good time with it. And that's a big part of what finance and estate literacy is all about.
Yeah. Remember, please remember that what we've discussed today, most attorneys don't know it. Most insurance agents do not know it. Most CPAs do not know about it. Most financial advisors and brokers don't know about it. So and it's not a panacea of a rich, quick scheme. This is a genuine way to help yourself, help the charity, help your family, and keep the tool in mind when you have a cocktail, bring it up.
And just as a note for people, when we get off of this, I'm going to tell Pete that whoever that financial advisor is, I'd be happy to run some numbers for him. Thank you very much, Pete. Enjoyed it.
Thank you, Don.